Hey everybody, welcome to the Thursday edition of the Financial Thing Investment Livestream. I used to title it as the Peer-to-Peer Lending Livestream, but as you know, I talk about other things also aside of peer-to-peer, so it is going to be the lending, peer-to-peer lending, news, stock investing, whatever. Just a lot of lending and investing information. Hope you guys are doing really well. Thank you for joining. Where else would you be on a Thursday evening, right? There's nothing good on the telly. Do people still say that? Telly? There's nothing good on the telly to watch on a Thursday at 7:30 p.m. in England. So come here, come chat, come learn about investing and what we talk about here. So what are we going to be talking about this evening? Well, couple of different things. Housekeeping. First of all, big thanks to Cufflink for sponsoring the live stream and also the Harley Cam. As you can see, very active dog this evening. But thank you to Cufflink. If you haven't checked out Cufflink, earn up to 9.83% gross interest per annum. Well north of over 250 million pounds of property-backed UK investments that Cufflink has made on behalf of you guys since 2016. Zero investor losses to date. Just remember that your capital is at risk. Don't invest unless you're prepared to lose money. This is investing. They call it that for a reason. And this interest rate can change as interest rates change. You can join, sign up, get yourself a free Cufflink account at join.cufflink.com/financial-thing. The link is below in the description. Thank you to Cufflink. We still don't have a date yet for Narinda, but he did email me and said we'll reschedule. I'll let you know when I know, but he is going to be here. I just don't know exactly what date, so patience is a virtue, as I was once told. I'll get hair out of place. Anyway, we're going to be chatting today a little bit of peer-to-peer lending news, as we always do. And there's been a buzzword that's coming up on the internet that I'm seeing over and over and over again in financial publications, also trending: private credit. So I'm going to talk a little bit about private credit and a news story that I saw yesterday that really made me go, wow. It was really a big wake-up call as to why you as an investor want to have complete 100% control over your investments, aka do it yourself. Of course, not financial advice ever, but news stories like what I'm going to show you are going to really put a punctuation point on why we do really need to manage our own investments, because even the professionals, don't always get it right. A lot of the times they don't get it right. So if you're going to make a mistake, do it on your own. You don't want to have to pay somebody else for them to make a mistake. Not to say you will. If you're educationally informed, you have a decent amount of knowledge, you probably are not going to make a huge mistake that's going to cost you. But anyway, we'll talk about that. We're going to take a look at the Trading 212 portfolio, which has been doing a lot better this week. Talk about what's going on with that. Let's see. I have a bunch of loads of tabs open today. I'm going to try to run through this pretty quick because I don't want to keep you here for too long. But yeah, we're going to talk about that. And again, private credit. What I noticed about that, and that really all ties in with kind of our topic this evening of private credit, what is going on with that, and why you might want to really think about putting your money into the hands of a management company. Anyway, let us get to it. Hi to everybody who's watching. Peter Vincent, Leatherhead, Colin Perry in a very wet Peak District, and Paul Bagworth in Kenilworth, and to anybody who's watching in the future, welcome. Please subscribe, hit that thumbs up, all that good stuff. Anyway, by the way, it is a very warm 20.5556 degrees here in Orlando today. So about 69 degrees Fahrenheit. Very nice. Very nice wintry day, but not cold. Anyway, let us get right into talking about the news. Here we go. Funding Secure investors withdraw over £6 million as payments restart. Payments to Funding Secure investors have finally been allowed to restart, according to a latest report from the administrators, due to an ongoing legal claim relating to a Quist closed trust. Payments to investors in the collapsed peer-to-peer lender were suspended in May 2021. A Quist closed trust. I have to Google what a Quist closed trust is, because I really never heard of that before. It's a trust created where a creditor has lent money to a debtor for a particular purpose. If the debtor uses the money for any other purpose, then it is held on trust for the creditor. Any inappropriately spent money can then be traced and returned to creditors. Okay. So the administrator, CG & Co., received a claim from a creditor relating to monies paid into the company's client account prior to the administration, including an assertion that the monies were subject to a Quist closed trust. They have now been able to allow investors to restart, that's they as in CG & Co., to restart the withdrawal of funds from their individual account, although some of the funds remain frozen. And I can attest to that because I logged in today and noticed about 20% of the entire, not the entire amount of funds I have on the platform, but my entire investment portfolio, 20% of it is stuck in frozen funds, which I presume one day, once things get cleared up, we'll be able to withdraw, but it's not a ton of money anyways. The joint administrators are now in process of drafting the defense of the company in the lawsuit. Over the 6-month period to the 22nd of October 2023, investors withdrew $6.27 million, brings the total amount of withdrawals to $30.67 million, which really is a small percentage of the amount of money that Funding Secure had on its loan books. This is very interesting because this Quist closed trust lawsuit is basically going to say that Funding Secure used funds inappropriately, therefore suing as a creditor. We don't know if this is a secure credit or an unsecured one. Haven't looked at the court document if it even exists, but another bit of a bump in the road for the administration on Funding Secure side. I think they have a pretty good case, and I do wonder if this creditor will sort of ripple a bunch of these lawsuits. Are kind of like, they call them copycat lawsuits, where you find a loop in the law that says, Funding Secure did us wrong on using this Quist closed trust. I do wonder if there will be other issues going forward. I don't know the answer to that, but it's a very interesting lawsuit that's filed. I think the problem with lawsuits, when you're suing a company that's in an administration, number one, you have a high risk of spending a lot of money on legal fees when there is no guarantee at all that you will receive anything back. Even if you win the lawsuit, still has to be money to pay out. Does the administration have the money to pay out if the lawsuit were to be successful? I don't know the answer to that. Maybe, some people just sue on the basis of moral standards of what maybe this person has money and they don't really care whether they win or lose the lawsuit, but they want to maybe bring Funding Secure to further justice than they already are, which I respect. I can respect that. Let's see, continuing on with the story. Meanwhile, the administrators have been able to achieve loan realizations of £2.17 million over that period, 6 months up to the 22nd of October 2023, taking total realizations to date of $48.75 million. Of course, this is lower than the number indicated in the previous update from the administrators, which had stated that almost $50 million had been recovered. So, a little bit low, $1.25 million lower, so we don't know what's going on with that. There are now remaining 30 defaulted loans with total outstanding capital amount of 19.12. So if you were even able to realize this 19.12 million on the remaining, which probably not going to get all of that amount back, you are close to what, 70 million pounds you would be in realizations, which again is really far short of the loan book that went into administration. But that is the nature of these administrations. You just don't expect to get the entire loan book back. During the 6-month period, the administrators charged additional fees of £54,759 plus VAT. Of course, you've got to pay the government, taking the total administration fees to £938,204. So God knows, by the time this is all said and done, what are we looking at? Probably 1.3 million in fees, maybe, for the administrator. So, it is what it is. Talking about rate hikes, P2P, Just Us, a company based in the UK, has increased rates on its cash account on certain property loans. The peer-to-peer lending platform said it has lifted the rate on its sterling access account to 5% from 4.75%. So not a huge hike, 0.25%. And then it's also increased the rates for its property-backed F risk grade loans to 10%. So F, which I'm presuming F would be the riskiest. I don't know. I've never really see if it says what type of loans they have. Up to 10.8% on adventurous. So that's the kind of numbers that you can get right now. Here's your current interest rates on Just Us. An F-rated loan, I don't know. I mean, to me, it just sounds like the riskiest of all possible loans. So for you to get 10%, okay. I guess you have to look at their statistics and see what their realizations have been. See, net annual return Just Us 8.12%, average loan size 84,000. Currently live on loan, £7.1 million. So they got a pretty small loan book if you compare them to other P2P companies out there. So, there's always risk versus reward, whether you want to get 10% for an F-rated loan risk on a small loan book. I don't know. That's something you'd have to assess. Investor update, assets exchanged November 2023. Some of you would have gotten this update in your inbox recently, and they're talking about what's going on with their loan situation. It says, we are pleased at Assets Exchange to consolidate our relationship with our Northeast partner by launching 2 further properties with housing and care provider Mears, number 176 Station Avenue North, which launched at a net yield to investors of 7.3%, creates a home for 4 asylum seekers, while number 179 Victoria Street was launched at a yield of 8%, will also house 4 people. So you got to give credit to Assets Exchange. They've really done, I think, favors for their investors, giving them these better yield rates now, which I think they had to do because in the 5s isn't really going to cut it anymore. But getting yields of 7 to 8% for Assets Exchange is, I think, a pretty decent deal. So that's good to see that I know they've been a little bit slow with their loans, and obviously they run a sort of formula that's quite difficult. They have to acquire properties at the right price, and then they also have to find relationships with partners that are going to put tenants into those properties and pay a decent amount of yield. So they're not the type of peer-to-peer lender that's just going to take on any project that comes across their books. They really have to vet them and source them. And but the good thing I do like about Assets Exchange is it's doing good for the community and giving homes to people that really need it, and where you as an investor can go ahead and get a decent amount of returns. Both of these properties, so another kind of an unfortunate thing, but it says here, both of these properties have been incredibly popular investors, moving up very quickly in price on the exchange, despite caps being placed on the size of holdings. So as they become more popular, these holdings, the exchange price moves, obviously. So if you get in at the beginning, you're probably going to do better than somebody that's buying the units on the exchange. We're working hard to bring similar opportunities to meet the demand, seeing these higher yields. They continue to work behind the scenes on improvements, and new features are outlined in our August update. We're taking a full overhaul of the risk ratings for each property on site. Process is now complete. We're doing the final review and writing explanations for investors. The new risk system should be released before the end of the year. That's exciting. Likewise, we're also undertaking testing on the feature mentioned in last month's update, which will allow investors to pre-place buy orders before a property is launched. I think that's a really cool feature. That should also be released by the end of the year. If you want to send them feedback, you can. Let's see. They are looking in the pipeline. They're looking at a yield above 7% on this new 9-bed opportunity. It was recently bought at auction from a home real estate trust or a REIT by our partner in the Northeast. Although this was briefly run as a homeless shelter, it now does require some significant upgrades. For me, as a commercial risk valuation is being carried out. We also are finalizing completion dates for the purchase of a property in Watford that will be leased to Grow Hostel, a local homeless charity, but is likely to be early January. Should yield about 7.3%. And they talk about an opportunity in Petersburg for a 2-bed bungalow that fell through. These things happen. So if you sign up for an assets exchange account, you can get this email into your inbox every month. Just gives you an overview of what's going on with the company. I think it's really useful to read these things, and we have to stay abreast of these things now, because we got to keep an eye on these P2Ps, make sure that they're running a tight ship. Quick prop lend update. Looks like it's going to be a busy year for prop lend up to the end of the year. They have completed 7 loans in November, funded 1 loan this month, and have another 6 more pending, pretty much ready to go. Doubt we will get all of these completed before the end of the month, but I'm hoping to squeeze in at least 3 more. Pretty cool. So, for everybody, I know you have to be quick with these loans. That's just the unfortunate part of when a P2P company offers a good product. Obviously, the demand and supply is going to be tricky, so you got to get in early. But there are some opportunities coming up on PropLend. Check out their emails they send through. That always tells you when the opportunities are coming, so you can try to be there for when they drop. But it looks like they have some pretty good things going on over at PropLend. If you are, unfortunately, in the peer-to-peer lending business in Poland, you are not a very happy camper. Oh, a nice picture of the, I don't remember what that building is called. It's like some museum of industrial action or building of industrial something. If anybody knows, let me know. European peer-to-peer lending marketplaces are pulling out of the Polish market before strict new lending regs come into effect. At the start of the new year, on January 1st, 2024, Polish lenders will be prohibited from borrowing funds from investors via online platforms. This will impact any peer-to-peer lending marketplace that had previously listed loans from Poland-based originators. Some of these companies like Peerberry have Polish loans, and that's really going to mess things up for them. At the start of November, Polish loans represented 16.6% of the Peerberry portfolio. Croatia-based peer-to-peer Lonvest has also opted to withdraw. It's an unfortunate situation, and this really highlights how governments can screw up sectors of business. I mean, the peer-to-peer lending business is very innovative, and when a government comes in and starts changing the rules and regulations, it obviously affects many different people. It affects the companies in Poland that are issuing loans peer-to-peer based. It affects the peer-to-peer companies outside of Poland that offer peer-to-peer loans within that country. And it really hurts the businesses too that need to borrow that money, peer-to-peer wise. Also hurts investors that invested in those loans. So everybody gets hurt. And it's usually done in, what they say, the guise, under the banner of we're trying to protect you as the people by putting these rules and regs into place. It was really very authoritarian, and it's unfortunate. And this is, a reason why I choose to invest in certain things that people don't always think is the best things in the world, but to be decentralized and away from government control is a beautiful thing. And not only can this happen in a place like Poland, it can happen in a place like the UK. The FCA decided they wanted to shut down a certain sector of innovative finance. I don't think it'd be too hard for them to do that. So it is happening in Poland. It's quite unfortunate. We talked last week about a blend project that they send out these emails showing what the finished products are like from the borrowers that are borrowing money from Blend to undertake these remodeling jobs. So here is one in Surrey from a guy named James, who's the property developer. It's in Haslemere. And he basically renovated this house with money that he borrowed from Blend. So I went online, took a look on Rightmove, and was looking through some of these photos. Pretty nice place. Look at this. Wow. I mean, this is a nice renovation job. You see the detail here. But when you borrow money through Blend, I don't know why I'm having such a problem with that today. These are the types of projects that are being funded for these developers being able to borrow money, probably that they wouldn't get from a high street bank. And it's creating new home opportunities in the UK and also upgrading properties that probably need doing. So a nice job to Blend for sending out emails like that. So let's talk about private credit. LendInvest founder launches a private credit fund. Faze & Co., an investment firm led by LendInvest founder Christian Faze, there he is, very cool, it's launched its first private credit fund, is looking to raise up to $100 million for property bridging in the U.S. The Faze & Co. Income Fund will invest in loans originated by Faze & Co.'s own group company F2 Finance, which was launched earlier this year. Will focus on funding diversified portfolio of short-term mortgages secured by first mortgages against residential property in the U.S. In the U.S., the mortgages work a little bit different. It's very, very normal to get a 40-year fixed-rate mortgage nowadays. 40, 30 years, 15 years are kind of the standard. But then you have these short-term mortgages that are usually on some kind of an adjustable rate. So a product that people in the UK are more than familiar with. So sometimes in the UK you might have a 3-year fixed rate and then it goes to an adjustable rate. So in the US it tends to be 5 years standard, and that's usually what they classify as really a short-term mortgage. Some home buyers really got themselves into trouble with adjustable rate mortgages when they took them out during the interest rate really low bottom points. You could get mortgages in the 1.9, 1.5%. And then, of course, when they reset after the 5 years, when these interest rates went to 6-7%, and all of a sudden they found themselves paying much higher amounts on their mortgage than they could afford. So it's kind of a dangerous product in some ways. So people don't really plan ahead, and especially when those interest rates hit. But they're very popular for companies to invest in. And as you can see, LendInvest is one of these companies that is going to try to enter that market. The fund will be lending to property entrepreneurs that are active in the fix and flip market, the firm said, as it looks to capitalize on growth in the U.S. short-term mortgage market, which was recently estimated to be as large as $68 billion a year in annual originations. Americans love their real estate mortgages. And Christian Faye said the U.S. real estate bridging finance market has undergone a recent period of disruption where traditional institutional funders have significantly slowed their appetite for a variety of reasons, from the securitization market being less open to regional banks that have had a flight of deposits via the crisis that's going on economically. The asset class presents a very interesting and unique opportunity for investors. It's also a very large and liquid market for building a diversified pool of asset-backed loans that provide a superior risk-adjusted return for investors. And this is just literally one story I've read about private credit. I think it can be quite risky, and the types of interest rate returns that you can get for investing through a fund that offers private credit are actually really low compared to the amount of risk that I think that people are actually taking. So you have to be very, very careful with that. Also, you're going to see some products that are going to be released and that have already been released on the investment front that are based around private credit. I think it is quite risky. This is the story I was referring to earlier that I saw that I was really surprised about. I want to show you this in case you're thinking about dipping your toe into this type of investment product. Chicago Teachers Pension Fund wants to enter market for private debt. The Chicago Teachers Pension Fund, which is Illinois' oldest public retirement system, wants to enter the hot private credit market with an initial investment of as much as $350 million US dollars. Whenever you see this word hot, you should be pretty careful. The fund on Monday said it issued a request for proposals to split the total among multiple private credit investment managers, setting the January 19th as the deadlines for bids. Chicago Teachers is the latest pension to join those flocking to the $1.6 trillion private credit market as a slowdown in mergers and acquisitions stifle growth in private equity. Public pensions are attracted to the market's outperformance and regular cash distributions that come in handy for benefit payments. So what even is the Chicago teacher's pension? Well, basically, if you work in the state of Illinois, you are going to get a pension. This is the fund that is being managed, this big pool of money. I don't know how much it is. It's billions. I know it's pretty large. So the $350 million in the grand scheme of things is not that big. I think it represents 3%. So tens of billions, not hundreds of billions. But the thing is that I noticed about this story is when I think of a pension fund, I think of low risk. And some of the things that were written in that news article here, I found to be a little difficult to believe. Let's see, public pensions are attracted to the market's outperformance and regular cash distribution. Now, the regular cash distribution I understand, but the regular market outperformance, I don't know what term they're talking about, but I didn't see it. What is private credit, by the way? Well, Morgan Stanley has a pretty good article about it. It offers floating interest rates that increase in tandem with benchmark rates. So these, right now it's a kind of a high point because the interest rates are higher, right? So the rates are going to be better. So what is private credit? It refers to lending to companies by institutions other than banks, right? So say, for instance, a pension fund like the Chicago Teachers, they've got a huge pool of money. They want to invest it. So what they're going to do is give that money to investment managers who are in turn going to lend that out privately to companies. I mean, it's not that much difference from something like Assets Capital. And what they do is they took money and they lend it out to companies, albeit small and medium enterprises. Now, one thing that the news article did say is that the Chicago pension will not give any money to an asset manager that has less than 500 million under management, which is quite big, right? So what they're going to do is give the money out to these investment managers. The investment managers are going to, again, just lend money to private companies. And they do have some rules about what they've said they do not want the money going to. And one of them was real estate, which is really interesting to me because real estate investments are backed by something tangible. Whereas if you lend to a company, you can usually, there'll be things like personal guarantees on a much larger scale, because these will be probably bigger companies. And then also maybe some of the assets that the company has or equipment. Not so good if you are trying to recover your money. So very, very, very interesting. Now, it's pretty interesting here. I want to show you the rest of this article. The pension system is seeking, you can see that, the pension system is seeking investment managers with a minimum fund size of $500 million and a so-called evergreen or drawdown structure according to the request for proposals. The fund doesn't plan to consider secondary strategies, trigger funds, or niche products such as fossil fuels, life settlements, death bonds, or real estate. Now, death bonds, I get, life settlements, fossil fuels, but real estate, I really didn't understand why they wouldn't consider that unless they think that the real estate market is this big hot bubble. Again, and now I'm seeing more and more stories here. There's another one about private credit returns beat the private equity market. So private equity is where you buy equity in a company and you have an actual share of the company, whereas private credit is a debt facility. But they're saying that the private credit has beat private equity in returns. And I wanted to kind of delve into what those returns actually were, because when this article said about this outperformance, and I didn't really look back too far because some of those numbers are quite tricky, but I looked back year to date just to kind of get an idea of what kind of performance these private credit funds are actually giving out to people, and it was really surprising. So I made you a little spreadsheet, a little graph here so you could see. Check this out. It's very interesting. I put it against some of the other investments that we talk about here, including peer-to-peer lending, the S&P 500 gold, index trackers, and Bitcoin too. Now, private equity is the first one on the list here, and this is what the percentage year-to-date returns are if you'd invested in private equity. So you took your money from January 1st to today, which is December the 7th. You would have gotten yourself, and this is an average over how they index this to track it, because it's quite a difficult thing to track, 4.33%. That's what it has returned year-to-date for 2023. That's private equity. So that's if you were to buy equity in a company and you average it all out over all these different companies, you'd have expected 4.33%. Private credit, the debt side of things, is a little bit better, 5.25%. Right? Not great, especially when you start comparing it to things like index trackers of the S&P 500, the Dow Jones. The only thing is beaten out of everything that I looked at was the FTSE 100. Okay, so the S&P 500 is 19.32% in the green for the year to date. So you absolutely smashed these two private equity or private credit investments by just investing in the S&P 500. Again, as a total whole, I know there's probably private equity and credits that have done better than these average numbers, but we have to look at things kind of as a whole. We look at the Dow Jones, 8.85%. And then our poor, lowly FTSE 100 year-to-date returns minus 0.53%. So the poor FTSE, again, not doing well year-to-date. Gold, even gold, up 11.6% year-to-date. Our Vanguard US equity tracker that we talk about a lot, 14.15% plus. Our Fidelity World Tracker, 12.85%. Bitcoin, which has had a incredible run this year, 171.64%. And then peer-to-peer lending, this has just been my average personally over the year to date, is 7.2%. So even peer-to-peer has beaten private equity and private credit. So what is the point of this? First of all, that pension company is going to hand money to management companies who handle assets. Now, I'm sure maybe if we look back further than year to date, we're going to see different numbers. There might have been times where private equity and private credit did much better than the stock market. But I think as a long term, if you take a very long-term view, I don't think you're going to see that. And this goes to show that, even a huge fund like this pension fund for the Chicago teachers is taking significant risk in areas that they probably shouldn't be. Why risk for such a low return? Even year to date, they could have just put the money into an index tracker and gotten themselves 14.5% instead of chasing after what they consider to be a hot market. So these people that work for the state of Illinois, who are teachers, who are expecting this pension, are now watching as this pension fund gives part of them retirement money away to investment managers investing in things that are not really performing. They're certainly not outperforming, if anything, severely underperforming the S&P 500, for instance. And this is why I'm so adamant about you being, educated as an investor about how to handle your own investments. Because if something that I think should be very risk averse as a pension union is giving the money to private managers to try to get 5%, that's total insanity to me. I mean, if you think of the risk reward, I bet the risk is like on private equity was way up here. Maybe private credit lower. Depends what, depends how it's secured, right? If it's not secured by anything, then your risk is massive. You're getting 4.3%, you're taking this amount of risk. But point being, these companies these pensions are just not really thinking straight, if I say it black and white. And you would think these are people that know what it is they're doing. I don't know where the rest of that pensions funds are invested, but I bet they're not in index trackers. I bet they've put them into actively managed funds. So this is why it's really so key and important that you learn how to do this yourself and take real control over your own investments. Of course, you're going to make mistakes. I mean, everybody makes mistakes, but the way not to make mistakes is to just take a very logical path, right? Just to pick trackers, you're just not going to make those mistakes that you can if you try to pick out stocks, or even if you give your money over to a fund manager who decides he's going to invest in private equity for you or private credit. It's kind of crazy. I just wanted to show you too, on this graph, how we have seen the FTSE 100 perform so poorly this year. I mean, so poorly. You're just almost 20% behind the S&P 500. This is for all the naysayers that say, "Oh, the U.S. is a bad market to invest in." Almost 20% behind the S&P 500, almost 8% behind a world track. 12.3% behind. Over 13% behind on the Fidelity World Tracker. It's crazy to me. I still don't understand why people continue to think that the FTSE 100 trackers are the way to go. I also, by the way, got an email. Somebody asked me, how do you chart these things on Morningstar? So I just wanted to show you how to do that, because I think it's a really handy tool to do a comparison of different things that you may be looking at. If you're looking at trackers or even just other types of index funds or mutual funds or unit trusts. But it can be a little bit tricky trying to compare them together. And I do actually like Morningstar as a way to do that. If you go to the website and you try to track through here, it can be quite tricky just finding out, like, how do you looking at this, how do you track a stock? The easiest way is to go up in this corner and type in what it is you're looking for. Now, the tricky thing is, if you type in Vanguard, you'll see so many different, for instance, if I'm looking for the US equity tracker, you're just going to see so many different options, and you're not going to really find what you're looking for very easily. Even if I type in US equity, right? You see, I don't know if you can see this, but up here, the first result is Common Contractual Fund GBP Accumulation Shares. You may not know if that's exactly the right one, because they also have different types of this tracker fund, but usually that's the best, honestly, way to do it is just go grab the title off of Vanguard's website and then just put it right in here. So US Equity Index GBP ACC, that's the accumulation. You can see here there's a institutional option here. But from there, if you click on the advanced graph right here, you're going to get this pretty nifty graph that comes up. And I want to show you too about the FTSE 100, just how badly this thing has performed over a long period of time. If we look back, say, 10 years. So here we have the US Equity Index Tracker. It's pretty cool because you can go ahead and put dates down here if you want. You can put in a year or pick ever what, 10-year, 5-year max. I usually just X out of these different things I don't want on the graph. And then you can hit this cool compare button right here. And let's say I wanted to track, for instance, the FTSE 100. So if I type in FTSE, you're going to get all these different options that you don't want. They're absolutely useless to what I'm looking for. But if you go here on the major market indices and you just scroll down, you can see here FTSE 100. You just click on that, and now it's going to give you your line that you can now see in red. So here's your Vanguard and here's your FTSE. And if I wanted to track a world tracker, let's see, and we'll put in Fidelity World. And again, if you do that, you see how these, I don't know if you can see this, but you're going to have all these different options that have come up. Fund A, Fund I, Fund 4. And again, that can be pretty confusing because you're trying to find something specific. So what I would do is just come up here and go Fidelity, UK World Index Tracker. And this is what I'm looking for right here. This is World Fund P. These are usually different issues of these funds. That's why they have these designations. So I might be institutional. Some of them might be older. So I just literally copy that, right? Go back to Morningstar and put that exact title in here. And there it is. It's going to pop right up for you because that's the one you want to look at when you're doing a comparison. So here you can see the three funds, right? This is the last year. We got the dark blue as the Vanguard US Equity. You've got your world tracker here in yellow, and then your lowly FTSE 100, which has just really struggled. I also like to go in here and do detailed view, and then you can see the numbers. So you want long-term percentages. You can see the three different 1 year, 3 year annualized since inception. So here, look at your FTSE 100 1 year. Remember, I was looking at year to date, which is minus 0.53%, but 1 year, if you look back to December 7th of 2022, it's minus 0.8. Look at these numbers right here. 5-year annualized return on a FTSE 100 tracker will get you 2.31% per year versus 12.14 and 10.99 on the US and the world trackers. So way falling behind. So listen, again, not financial advice, but the numbers don't lie. This is just the way it is with the FTSE 100. And honestly, it's getting worse for the UK with their stock situation. I read a story. Let me see. If I have it. Yeah, TUI is considering dropping out of the London Stock Exchange. So the London Stock Exchange it's not considered as strong as it used to be, and this is going to also affect, in some ways, the way that these companies operate and the profits they make, and it's going to affect your investment if you are invested in these trackers, these FTSE trackers. If we look back, this is what's really kind of shocking. This only goes back to 2009, but you're going to see here, just look at the red line, how poorly it's performed against those other two. Even if you went world, you're going to be much better off than picking the FTSE 100. It's really just struggled to get any type of traction. You really have to time it really well to be able to make any money off a FTSE 100 tracker, like getting in at the very, very lows, which, as you know, is extremely difficult. It's very, very, very hard to do. And you're better off, honestly, just picking a world tracker and saving yourself the headache of hoping that the UK one is going to do well. And I know some people are patriotic. Some people are like, oh, I'm a British person, so I must invest in British companies and British trackers. And yeah, I mean, sure, if you want to get those type of results, then go ahead. Not for me, but maybe it is for you. I don't know. But look at those numbers if you want to comparison. Morningstar, the UK website, is a really good way to just get a good visual of what the heck is going on with the performance of these different investments you're looking at. And you can set your own dates too if you want to just go back 1 year. You can see what's going on 1 year, 3 year, 5 year. Very easy to see which ones are doing better than the other ones. That's cool. Let's look at the Trading 212 portfolio. We've had a pretty decent run by actually moving into those two new trade positions of Coinbase and Rivian. Now, I didn't get as much into Rivian as I'd wanted, but you see here, account value just shy of 18,000. We were down at 17,200 just a couple of weeks ago. Coinbase has done quite well since entering that position. 10.63%. Had a bit of a pullback. You see, pull up the chart. We were all the way up at 146 at one point, so $10 less, but up about 10% on that. And then Rivian, the other stock, which has actually even done better, is in the portfolio up 15.33%. And what I've been doing with these Coinbase shares, instead of buying market positions, I've gone ahead and set limit buy orders, or I did. One actually filled earlier today. I usually don't do limit buy orders on this portfolio because I'm too impatient. But I did set a limit buy that got filled at 132.50 today. And that, I thought, the price was over 140. It was like 142. And I thought, it's a pretty volatile stock, so let me just set a limit buy and see what happens. I've noticed it been moving. The stock price has been moving around a lot. So it got filled at 132.5, only 4 shares, but still, I mean, an increase is an increase. Rivian, I really wanted to get in at a lower price. I think 16.5 was a good price, and now we've run all the way up to 19. Again, this is a pretty volatile stock. You can see here how this thing has performed all the way down from 28, bottoming out here at 12, so lost 50% of its value. So, and then also again seen another run up to 27. So we kind of got in really down here. I still think that Rivian is going to do better than Tesla as far as the stock performance goes. Question is, there's always that emotional decision of, do you buy back in when you've seen it run? So if we look at the last week, 13.6% for the last week, do you buy back in now? I generally tend to be jinxed when I'm buying a stock that's running. This would be me buying up here. normally. I'm watching that happen. So I'm a little bit emotionally struggling with when is the best time to add to this position. But anyway, the portfolio is doing okay. Norwegian's, in the green, 5%, which is pretty cool. Deutsche Bank, 4%. We're still waiting for these stinkers. Alibaba, negative 25%. Green Power, negative 31%. And Vermilion, oh my poor Vermilion Energy, down 43%. Not looking good. I mean, look at this. It's just like the hell of death. Down into the volcano, $15. Look at this. We're all the way at 18. Now down to 11. So probably not going to change this position. There is one thing that could be done. I mean, could sell it off, take the tax loss of the £713, and then take that money and bang it into something that you think is going to do better. But I don't know. I'm probably just going to wait till the end of the year and see how it does, and then maybe sell some of these bad positions and just take the tax write-off on the loss. It is called tax loss harvesting for anybody that likes the technical terms. But yeah, the portfolio is doing okay. So really trying to run this back up to 20,000 so we can give more money to charity from the portfolio. So yeah, please don't do as I do. This is informational purposes only. You can really get burned buying stocks in this manner. So let me be the one that takes the hits. Unless you're very, very experienced, you have a lot of knowledge of these stocks, I would not recommend buying them in this manner. It's extremely risky. Anyway. So look at your comments, and then we are going to get out of here. TV is good. Alibi is showing a repeat of Sherlock Holmes. Oh, okay. Hi, Mike Powell. Unsecured creditor that I presume you're talking about is suing Funding Secure. Hi, Peter Clark in Huntington. Annabelle, hola. How are you? Lionfish hunting. Pot in Bowden Town. Sounds like it's in the Caymans. Yeah, always a worry when everyone is talking about a particular investment area. Probably a good time to be moving out. Interesting, yeah. You can, Dave, interesting comment. You cannot just look at year to date. That's not indicative of what we'll get safely over time. Yeah, no, I totally understand. And I would actually like to look at the private debt and equity returns on average back further from that. I just didn't have time to do it. I know year to date is not generally the best timeline to look at, but I think it's very interesting that report comes out at this time when, for an entire year, that market has not been very good. And I still stand by my statement that private debt and equity for pension fund to be giving money over to investment managers to be loaning out to companies is extremely risky. I don't think that's a low risk proposition at all. Dave Dawson, does your peer-to-peer include total losses? Not total losses. No, that was just a year to date. What my year to date returns have been. I take off some of the losses depending on when they occur. So yeah, there are some losses included in there, but not a whole lot. I don't think this year. So it's been okay. It's been okay peer-to-peer year for sure. Anyway, that's going to do it. Thank you for joining. We'll be back next Thursday, all being well, from myself and the little sleeping pup she's just precious. I don't know. Fills my heart with joy, as do you, each and every one of you that come here and spend your Thursday evening with me. Thank you again to all the Patreon supporters for your loyalty. It's really appreciated, and thank you for being here. I'll see you on next week, hopefully, and have a great weekend. Enjoy the hopefully not too cold British weather. And I will see you then. Take care. That's all I got for you this week. Bye.